Hey everybody, what's going on? I'm going to talk about hedging a little bit today. The idea of beta. I'll talk about why this even came up for me, and yeah, we'll just kind of hop into it here. I'm going to throw the live stream chat here into Twitter. Should be going on Twitter right now. Cool. I'm just going to drop this link in Discord and we'll get started. Okay. So the first thing I'm going to do here is I want to talk about what beta is, first of all. And there's some of these concepts have math behind them, but once this is up on YouTube and everything, I'll share the links in my writing which cover that, because I'm not going to go like step by step into like derivations or anything, but I just want to make some of these concepts really practical. And so the first, where did this start? So I own some VIX futures, and I was throughout the last couple of weeks, been doing some trading, and I'm getting some deltas, and I had some SPX deltas. So I was kind of wondering. I was like, oh well, how many VIX futures do I feel like is roughly a hedge for owning SPX? Like if I wanted to be market neutral, didn't want to liquidate the SPX, and I wanted to just own some VIX futures. That was kind of where the question started, and I made a little tool in the spreadsheet that I use to sort of manage everything, and I figured, this tool is actually more widely useful than what I'm using it for, and by stepping through it, it would be I think it would be a good educational experience, and bring some of the things I've talked about, which are really sort of common practice, but make them really concrete. So let's just kind of hop into it here. You can see on the screen I have this. I kind of wrote notes for myself so I can remember, but talking about the first thing is we're going to talk about beta for a second. So, and again, the context here is like, imagine you have some asset, you're long some asset, and you want to sell some other asset to sort of feel like you're mostly hedged. And I can talk at the end of this about the context for where these kinds of things come up a lot. But let's just hop right in. So first of all, beta, you could think of beta as the sensitivity of a dependent asset return to an independent asset. So, and this all kind of comes out of the CAPM kind of framework. So, and I said, the things I might say are not exactly, they're not academic. They're not be like, for example, if I talk about Sharpe ratio later, I might not be taking out the risk-free rate. I'll kind of, again, this is meant to be very, very practical and sort of trader oriented. So with the concept of beta, you can think of beta as the way somebody might use beta is okay. If I have an asset that has a beta of 1.5, so then I think if beta of the S&P. So if S&P is up 1%, then that asset I expect to be up 1.5%. And that would be sort of like its beta adjusted. It's beta, it's expected return based on its beta, right? So beta is so one thing you can do, and this is kind of like CAPM framework stuff, is you can just plot the daily returns, for example, of two assets on a scatter plot, and then the slope of that regression line would basically be the beta. It would be the sensitivity of the dependent variable to the independent variable, right? But beta is it's also, the algebra also breaks down to what beta is it's the correlation between the two assets times the vol ratio. And let's just understand that very intuitively. So what does correlation say? Like if two things are, if you have an asset that two assets that are 0.8 correlated to each other, what that's saying is if the independent asset goes up by 1 standard deviation, then in this case, we'll use SPX. So if SPX goes up 1 standard deviation, I think that, and the correlation is 0.8, I think the dependent asset, the other asset, is going to go up by 0.8 of its standard deviation. So this is, first of all, like pretty useful thing to just know. Like what correlation is saying is, it's really measuring in units of standard deviation. So it's saying, okay, if this thing's up 1 standard dev, this thing's up 0.8 standard devs. If that's what the correlation is. If the correlation is negative 0.8, then if this thing is up if the independent asset, if SPX is up one standard dev, the dependent asset is down 0.8 of a standard dev. That's what correlation says. Now, because every asset has its own standard deviation, its own volatility, that's why we actually multiply the correlation times the vol ratio, because that allows us, that turns it into a beta, and that allows us to make a statement like, if this asset's up 1%, then this other asset's up 1.5%, or so that's why. So what we do is we take the vol ratio of y to x, so that the dependent assets vol divided by the independent assets vol. In that vol ratio, we multiply that by the correlation, and that's how we can make, and that's how we get a beta. And so beta is not just the slope coefficient in the regression. It's also, you can also think of it as the correlation times the vol ratio. Okay, so now one thing that happens is, like, anytime the correlation between two things is not 1, and even if a measured correlation is 1, remember, like, all correlations are effectively sampled, right? They're based upon, hey, what is the correlation of these two return streams? But this is just sampled. I mean, God doesn't say what the correlations between these things are. These are just observed. It's empirical. So the concept of what's very important is this idea of, if two assets are highly correlated, there's still some wiggle in that relationship, right? If the beta is 1.5, if asset A goes up 1% and asset B goes up 1.5%, well, we're not gonna, if asset B only goes up by 1%, that can happen, right? That's not God doesn't say that this asset's got to go up by its beta, right? So something we really care a lot about is sort of how much wiggle is there in that relationship. So that's the idea of, this kind of goes in CAPM terms. They talk about this in terms of systematic risk versus idiosyncratic risk, and then sort of like the trading and pod world has adopted this lingo of idio. When I started at SIG, we didn't call this idio, but we called this concept of the idiosyncratic risk, or the risk that is not explained by sort of like the S&P or your benchmark. The risk that is not explained by that, we would just call that risk remaining. Okay, I think they call that idio today, but I don't know if SIG does, but that's how I learned it. So risk remaining is, and the thing about the formula for risk remaining is, it's the square root of 1 minus the r squared. R is correlation. So if you take a regression and you took the square root of 1 minus r squared, that would be your idio, or your risk remaining. So this is what's really important about this is, you'll see that let me show you this picture. Let's see, where did I put it? No, it's not over there. Yeah, here it is. Here, make this a little bigger. Yeah, so over here, this kind of do the math over there, but like, this is the picture you care about. This is kind of, if you've never seen this before, you probably find it pretty interesting. So as your correlation, correlation can be between +1 and -1. And what this chart is saying, and remember, this is just plotting idio, or as a function of correlation level. So remember that correlation is it's the square root of 1 minus the r squared. Okay, that's idio equals. Okay, so notice here. So, and the way to interpret this is the y-axis is saying how much unexplained risk is for a given level of correlation. And what's crazy about this is once the correlation drops below 86.5, or obviously if assets have a -1 correlation with each other, like an asset and its inverse asset, that's a very tight relationship with each other. They're going to hedge each other very well. So if your correlation is anywhere between negative 86.865 and negative 0.865, that's the point at which that's your 50% point. That is where if your correlation was less than 86.5, then more than half of the volatility in the relationship is idiosyncratic or unexplained by the benchmark. Unexplained, we usually use the S&P. It's sort of like unexplained by the S&P's move. So if you're trading like two assets that are 90 core with each other, it's pretty. If you're looking at 90 core, you're kind of up here where I can see the hover over. I don't think you can, but then it's 44% of the risk in the relationship is unexplained, right, at 90 core, and which is, I think, is a bit unintuitive because you think, oh, these two things are 90 core, they move with each other all the time, and it's like, no, there's still a lot of unexplained variation in that relationship. So and I think this is a good picture because it shows you how this scales. Like as you go from +1 correlation to 0, you have this very this curved relationship here where the risk remaining is sort of exploding as the correlation falls. So anyway, what I want to do now is actually show you how this tool works, because we want to get back to this question, like, well, how many deltas do I need to or how many dollars do I need to sell of something else to be hedged against, say, my S&P, or how much VIX do I need to buy to be hedged against my S&P, from just on a statistical basis. Again, like not actually believing that these relationships are necessarily going to hold. Okay, so let me show you the tool works. So let's scroll all the way to the left here. Okay, and then so let's see. I just want to make sure this is kind of legible here. We'll just start with like this amount of view. So, and I'll explain what's going on here. So what I do is I put two tickers in here. So here in this case, I got SPY and VXX. VXX is holding the front 2 months VIX futures. I put SPY and VXX. I'm looking at daily returns, so I can I could toggle between daily and weekly. I'll just leave it daily. History, I'm pulling data from 1,000 days ago. So the last date here is 4/22. The first date is July 27th of 2022. That's 1,000 calendar days. So your actual N or trading days is going to be 686. And where is this data coming from? And this is what's cool. You can do this too. You don't need to subscribe to anything. Well, you need to have a Microsoft license, I guess. But all I'm doing is, if you go all the way over here to the right, this is kind of where the magic happens, I guess. It's just two formulas. If you go here, you can see this formula up here. What I'm doing is I'm just using the built-in Excel function called stock history. So stock history is pulling in SPY from the start date to the end date. And then I do a little VLOOKUP here based upon whether you're looking at daily or weekly. And then so it'll give the interval. So these are giving me daily intervals. So you can see daily trade dates here. And then I have this sort function wrapped around it, because if you don't sort it this way, it comes in as the oldest date first, and I wanted the newest date first just for charting. Anyway, so that's SPY, and then I just do the same thing here. It's just referencing this this cell here, VXX, and then from there over here, I have my helper columns where I'm just turning this into daily returns, and then I compute the beta. Okay, how do I compute the beta? This is actually pretty simple. You just go here, and Excel has you can use this function right here, linest, to, and linest is basically like a linear regression formula. And I'm just going to do a linest where I'm looking at the trailing 21 days. So this is 21 days. So like 21 business days, which is like looking at monthly, right? It's like a rolling monthly beta. That's what data we're looking at here. So based upon these returns. And so we can see that this linest function, it's actually kind of an array formula that's built into Excel. And so it tells you the slope and it tells you the intercept. But the slope, remember, that's the beta. So the beta here is 2.95, which means that if SPY is up 1% and the beta is negative 2.95, we expect the VIX to be down 2.95%. Now this is, looking at change in vol as percent terms, which is dangerous over really wide ranges of vol, because vol sensitivity probably depends on the vol level. But if I'm just looking locally, it's good enough to look at. It's going to get you in the right ballpark. And then here, since I already have these return streams, it's no problem to compute the correlation. And then I have the IDIO here, right, which is that formula we described before, square root 1 minus the R squared, right? So remember, R is just correlation. So this is just 1 minus this column squared. So this does all the math that we're going to end up referencing back for the charts. So it's really simple, and you don't need anything more than Excel. With you probably have to have like the annual license to it. I don't know how much that costs, 50 or $100 a year. I don't even know what it is, but and then you just use that stock history function, right? Okay, let's go back to here. Okay, so this is my rolling beta for VXX versus SPY. And we can see that's kind of like the last point we had there was that negative, again, you can't see the hover over, but it's that negative 2.96, call it -3. So this is S&P up 1%. You expect the VXX to be down 3%. Okay, so remember, beta look back window, 21 days. I kind of default to 21 days. If you pick daily, if you went in this cell, you could override this and say, hey, I want to look at 50-day look backs, and it'll change the chart, but just leave it in the default 21 days. Okay, and you can kind of see that how the VXX beta to the S&P has moved. This is a volatile relationship. It has moved around a lot over time. And if you look over here, this is leading up to, remember August 5th, we had that, you're getting down here, there's a -8 beta move, right? This sort of like giant response in vol on August 5th compared to how much the S&P had fallen that day, right? There's massive response, and that's why you see the betas just absolutely spiking to, in this case, -8 on a 21-day look back. One of the things that's interesting is like you get these periods of time where the beta of the VXX gets really small. Like it actually crosses 0 here, and leading up to August 5th, this is on July 24th. So, 2 weeks before August 5th, the beta of VXX got very, very low compared to SPY on a 21-day basis. Now, I'm a little hesitant to read too much into that because, it actually brings up lots of interesting questions for, I think, like one could go and try to study. For example, what this is saying is that the spot vol relationship became more muted. Like the vol wasn't really responding to changes in spot. one of the things that comes to my mind immediately is to probably wonder about, well, how did the risk reversals look in this period of time? Like, how is put skew priced? I mean, if the market has down days and the vol doesn't really respond in a strong way, maybe the put skew was very expensive around that time. Maybe, or maybe the put skew had adjusted to this and has become very, very cheap. I mean, maybe leading into August 5th, we had built up so much short vol, and that was sort of the harbinger of it, was that vol was not even reacting anymore on say on down days. So all this built up vol was showing was sort of released on August 5th when we had the move, and then it was kind of like, oh, the tide went out and we found out everybody's short vol or whatever. But uh, I think there's actually more of a technical reason. I went and looked at the actual daily returns in this period of time, and it actually highlights a problem with the computation of correlation in general. Is that this was actually a pretty low vol period in July, where the daily returns in the S&P were really small. So what happens is you get these, like, you might get a day where the S&P is up 10 basis points. Well, if the S&P is up 10 basis points and vol happens to go up 15 basis points that day, which is, nothing for vol, that's going to screw up that correlation. It's going to say, whoa, S&P was up and vol was up on the same day. But the truth is like, it's just noise. I mean, it's just 10 basis point move in both of these things. So, but correlation doesn't care that, the correlation is just looking at this and saying, well, you were up the same. Both assets were up on the same day. And it's just going to say, oh, that like it's going to push my correlation more towards zero or positive. And I think it's just an artifact. If you just have like really small moves, it still gets picked up as like, even though those moves don't matter that much. So uh, that's I don't know. That's maybe a technical thing that could be the reason for why these betas were sort of approaching zero. And remember, beta can approach zero, or betas can change in two ways, right? Because remember, its beta is correlation times vol ratio. So the betas can increase because in this case, because the correlations might be tending more towards zero, or it could just be that VIX vol is falling faster than SPY vol is. So VIX moves are becoming smaller than compared to how they typically move around relative to how SPY moves are changing. And so that could be another source of what's pushing the beta closer to zero, is that VXX is just becoming less volatile, or was sampling less volatile period leading up to these numbers. So I just want to show you what else we do here in this chart. So we have the beta here. Down here, we can actually look at, by the way, I'm keeping this kind of small because I know it's like, I want the resolution to be reasonable. Okay. So here, the black line is correlation. And then, and we can see that the correlation between you can see that there's a pretty strong negative correlation lots of times between, say, 80 and 100, but then you get these spikes in correlation where the correlation actually pops up closer to zero, right? And then this red line is just the idio or unexplained risk, and it's really just the mirror image because it's just that formula, square root of 1 minus r squared. So it's just pointing out that, hey, when the correlation goes towards zero, there's just a ton of unexplained risk. Like in other words, there's no systematic relationship between these two things. It's like all unexplained risk. Okay, and that's intuitive if your correlation between two assets is zero or small. Okay, so this chart shows the correlation over time. And then, so this is a time series of the correlation. And then we saw here that the correlation, or the beta, was -3. And then right over here, I might have to expand the window a little bit. You can see this. And this is just full sample. So instead of a time series, we just say, hey, let's just look at the scatter plot. And so this is S&P returns on the x-axis, and then VIX returns in percent terms on the same day, and for the whole sample, and you get an R squared of 0.51. So if that's R squared, that means that the correlation's got to be about 0.7, right? Well, because 0.7 squared would be 0.49. So this is corresponding to a correlation of about 0.7, and that's full sample. So even though over here we can see the time series, it does spend a lot of time, sort of a stronger correlation than negative 0.8, but over the full sample, it sort of averages 0.7, and that's because we get these spikes here, right? So we can see full sample and we can see the time series through this. Now, and here's the thing, we can do this, if you have this tool, we can do this with any, let's go back. I'll just expand it. Now that you've seen it a little bit up close, I don't mind kind of expanding that. And then we can just put any symbols we want. So SPY, say, hey, how's SPY versus IWM? Okay. And then let's move this guy here down a little bit. Okay. So here we have a beta, full sample beta of 1.08. So IWM is more, remember, IWM is the dependent variable. So is a 1.08 beta full sample. It has an R squared. This relationship is an R squared of 0.7. So that's somewhere in the ballpark of a 0.85 correlation if the R squared is 0.7. And we can see that here in the time series. You can see that IWM and SPY daily returns tend to be pretty strongly correlated. And then you've got, and you, again, here you get that August 5th effect, which is kind of highlights to the degree to which it was a SPY-centric move, right? Because what's happening here is your beta, normally IWM is more than one beta, right, to SPY. Even though the correlation is less than 1, IWM's vol premium to SPY vol is large enough to overcome that sub 1 correlation to make it have a beta of more than 1, typically, a beta of 1.08 over time. But you saw this situation where the beta actually went 0 or negative, actually. And that's because the denominator, SPY vol, roofed relative to IWM vol. Again, highlighting the degree to which that was a very August 5th was a SPY centric kind of move. So we'll just put different symbols in here, and we can look at various things. Like we can do let's do USO versus how about XLE? Okay, all right. This relationship is trash. Your R squared is 0.45, which means the correlation between these two assets is less than 0.7. This is your beta over time of XLE to USO. So XLE tends to be lower beta than USO mostly, but recently we got this beta that's over 1 of XLE over USO, and we can see part of that's being driven by the correlation spiking, right? And this is kind of what happens when the market gets stressed. That there's that old saying, all correlations go to 1. I mean, you will see this as vol picks up, correlations do tend to increase. It's pretty easy to see in the data. So here you got the situation where XLE's beta actually roofed compared to USO, and that and maybe that's XLE. Remember, look at this unexplained. Like XLE is partially explained by oil prices, but at the end of the day, these are corporations, and the corporation factor or whatever must have taken the lead here in the recent sell-off in stocks. So you're kind of getting this giant spike in beta between XLE and USO. Okay, let's do some other ones. How about IAU, which is gold, versus PSLV, which is silver. Okay. All right, so your R squared here. So first of all, one thing you notice here is that the correlation, we're sort of middle of the range, puts about 0.7 recently, full sample, the correlation tends to be higher than that, because if you got an R squared of 0.6, I don't know what's the square root of 0.6. It's like little less than 0.8, maybe like 0.78, somewhere in that ballpark. So the typical correlation is usually more like 0.78. Right now it's only 0.7. And you can see the beta. Typically the beta is of silver to gold is 1.48, call it. And that's because silver is more volatile than gold. So even though they're pretty reasonably correlated most of the time, silver is a lot more volatile than gold. And that is what drives this much fatter beta. But lately, this recent rally in gold prices has been, gold has been completely outperforming silver on this up move. And so you're seeing that gold's vol is almost as high as silver's vol right now. So you couple that with the fact that their correlation is about 0.7, and you end up with this beta that's actually pretty close to 1 right now between gold and silver. So you can sort of see that how gold is the action in gold is leading to this change in the relationship. Okay. So let's see some other ones. Let's do, actually here, let's go back to SPY for a sec. And we'll do SPY versus, let's do RSP, which is equal weighted, SPY equal weighted. Okay. So first of all, now you're getting this really tight, you are getting this tight relationship now, right? Now you're talking about your higher 0.85 R squared. So your correlation is north of 90 between these two in terms of daily returns. And you can see here, these things are, they spend a lot of time above 90 core. And then you've got this, but then you do have these periods of time where it's again really interesting, that August 5th period where the beta collapses based upon SPY vol basically roofing. It's pretty. It just shows up in every chart. And then, but again, you can see how tight this relationship is between equal weighted SPY and SPY itself. But again, it's pretty. I like this thing because it's like you don't even need any external data. Like you can just have Excel and have this, and bang, you can see how two assets compare to each other, how they move with each other, how their relationship like looks over time. So, and all of that basically informs your hedging ratios, your between two assets, and then once you have a hedge on, you also, because you know what the IDIO is or the unexplained, that will also tell you that how much noise you expect in that hedge. So you might be long 100,000 VXX, or 100,000 SPY and 100,000 VXX, or sorry, 33,000 VXX. Remember, VXX was -3 beta. So if I have $100,000 worth of SPY, then I have $33,000 worth of VXX, which has a beta of -3. I think that portfolio looks hedged locally, right? But there is a lot of unexplained risk in that relationship here, right? We got right now the correlation is like relatively high between the two, but your unexplained risk there is about 40%. So so 40% of your daily volatility in SPY is sort of like not accounted for by your hedge. So if your daily SPY vol is, if you had 100,000 SPY and SPY vol is 32, that's your daily standard deviation is $2,000, right? And 40% of the $2,000 is $800. So you have like $800 of unexplained P&L just due to the wiggle room between VXX and SPY, right? And again, this is all local. It's actually one of the things that's kind of interesting is like, I'm just going to shorten this real quick, 500. We see it again here. This is VXX SPY. So full sample, you have a beta of -3.5 but the beta itself is really quite volatile, not just because the correlation has some volatility in it, but because the vol ratio has some volatility in it itself, right? So all of that contributes to the beta of VXX to SPY being pretty wild. And even though for full sample it's negative 3.5. One thing is, let's actually just change this to weekly. And what we do here is when I change it to weekly, you get, so basically you're zooming out, right? You're like, what's the relationship? What's this is the scatter plot of weekly returns, SPY versus VXX. And you're getting, actually your beta is about the same, still about negative 3.5. That actually didn't change much. And then you can kind of see how the beta changes. And what I did here, I defaulted my beta look back window to 8, so 8 weeks. So when you switch this thing to weekly, it looks at the last 8 weeks. Whereas when we looked at and that was just like to get more data in that beta, but the when we looked at it daily, remember it's 21 days, so it's like a month's worth of data is feeding that. Okay. Okay. So, okay. Now I just want to talk about some stuff that's like of practical use in terms of how I sort of like keep a sense of proportion around risk and sizing and how it kind of relates to ideas like this. So, let me see. I had notes somewhere here. Yeah, well, I don't want to make this too distracting, so I'm gonna talk about it down here. Okay, so oh yeah, one thing I did mention how this is it's a bit adjacent, but I mentioned how if you look at the returns, you could look at this weekly, and you could look at it monthly, and you say like how does this relationship look monthly? But the problem is like the more you zoom out, one of the things that we're completely hand waving here is the concept of drift. So, and I can and the more you zoom out, the more important the drift component of an asset's return becomes. And when we're looking at daily returns, we can pretty much just hand wave the idea of drift. And to give an example of that, I'll just talk about, let me just explain it using what I've got here. So think of like a 1 day like S&P. Like if the S&P returns on a typical day, if you were to just look at like annual S&P returns, right? If we call it annual S&P returns somewhere around 8% a year on a 16 vol, I think that's a decent historical rule of thumb. Daily, that means that your drift is the market goes up 3 basis points per day. And if you want to say a typical vol is 16%, that corresponds to 100 basis points of vol per day. So a typical day in the S&P is like you expected expected return of 3 basis points and a standard deviation of 100 basis points. So your daily Sharp in the S&P is this tiny number, 0.03, right? 3 basis points divided by 100 basis points of variation. So you have a daily Sharp of 0.03. And again, we're ignoring the risk-free rate here, but like if the risk-free rate is 4 or like half the S&P return, that would be a 1.5 basis points of drift per day. So really, you should probably only look at the Sharp as the excess return over the 100 basis points, but we're not going to do that. We're just going to stick with like 3 basis points. So one thing you kind of notice here is like we all kind of know just from like being around markets, like, okay, S&P, if it returns 8% a year, and we know that it's got a vol of say 16, the S&P is roughly a 0.5 Sharp asset. I think that's been more true of the last decade, and maybe for over a longer history of time, it's been more like a 0.4 Sharp asset, but like we'll just go with 0.5. Okay, so if your daily Sharp, if your annual Sharp is 0.5 and your daily Sharp as we showed above, is 0.03, right? 3 basis points over 100. The difference is 16, right? Notice, so what do we know about 16? 16 is the number that we annualize from daily to annual when we annualize vol. So if you take that 3 basis points daily Sharpe ratio and you annualize it by 16, and if you actually like work through all the math, like it works the exact same way, but this is just shorthand. You just realize like, whoa, 3 basis point Sharpe ratio per day annualizes to a 50 basis point Sharpe ratio strategy, because it's just the 3 times the square root of 251 trading days in a year, which is approximately 16. So now think about like a really high Sharpe strategy. Let's just take something crazy like a 16 Sharpe strategy. That would be something that returns, say, 1% a day and had a volatility of 1% a day. So it's like you're making $5,000 a day, give or take $5,000. That would be, if you did that on a daily basis, once you scaled that over a year, so you would take that and be like, well, I have a 1 Sharpe strategy times the square root times 16, the square root of 256. That's a 16 Sharpe strategy annualized, right? So if you have, so that's a crazy example. That would be like, in my business every day, I make 10 grand a day, give or take 10 grand. That's an insanely good business, right? If you have a Sharpe 2 strategy, so now we could just do the math in reverse, right? So Sharpe 2 is like 2 Sharpe divided by 16 is a 0.12 Sharpe per day. Okay. Now, this is where we can start thinking about contextualizing what your actual performance looks like. So if you have a 0.12 Sharpes per day, that would be the equivalent of your swings being 8 times larger than your daily P&L. So if your daily P&L is $1,000, give or take $8,000 a day, that's actually that's what a Sharpe 2 strategy looks like. And that's considered a good strategy. That would be like that'd be a really good investment. So and that's what it looks like on a daily basis, that your swings would be 8 times bigger than your expectancy or your average profit, right? So and think about what that means for a year. Like let's say that in a year you expect to make let's say you got a business that makes $5,000 a day, okay, and you swing 40,000 a day, right? Your swings are 8 times as big as your daily expectancy. So you make $5,000 a day, give or take $40,000. Okay, that'd be a Sharpe 2 strategy. But at the end of the year, that $5,000 a day annualizes to $1.25 million a year of expectancy, right? But your volatility of 40 grand a day annualizes at not at the number of days, but the square root of the number of days. So what happens is your volatility annualized becomes something like 600,000. So now you have a business that makes $1.25 million a year, give or take one standard deviation move is 600 grand. So let's say you have a bad year. You have like a 1 standard deviation bad year. So instead of making 1.25 million, now you're only going to make 625,000. We'll call it 600,000. If you have a 2 standard deviation bad year on a 2 Sharpe strategy like that, you'll basically make nothing that year. You'll break even. So and so the two Sharpe strategy on the left tail, on only the left tail, you would expect that to happen only 2.5% of the time. So in 2.5% of the time, so 1.25 times out of 50 years, like that's how powerful a 2 Sharpe strategy is. Is like you pretty much guaranteed to make money, compound over the long run. I mean, this is literally the stuff that when you go to a trading shop and market making 101, it's like, this is the lesson they try to drive into your head, the absolute primacy of edge. Like if you have edge, it's like the exact equivalent as being the casino. As sure as like having a negative edge will grind you to death, having a positive edge just basically guarantees you're going to become rich. So getting an edge is really hard, of course, but the point is, like, once you have an edge, that thing is the lifeblood. And this is kind of like how the sort of like the math, how the math kind of bears itself out. Now, okay, how do I now tie this back to what we talked about with like these concepts of like hedging and the risk remaining, how much volatility is in the hedge? So this is kind of how I would think about it, is like, okay, you have to have some fingertip sense of your business. Like, you know, how much money am I able to make in this business per day? So if you're on a trading desk, you kind of have some idea. It's like, well, if I think I'm getting 2 cents of edge per contract and I trade, 1,000 contracts a day, um, that's 2,000, that's $2,000 a day or whatever. And you'll be able to have some statistics about how much you trade per day, how much your edge is on the contracts, all that. And you can start to get a sense of like what your business looks like. And then you have some qualitative sense of, as the market's kind of changing, like if this an especially busy year, which probably, um, uh, or is the volatility in the marketplace lower than it typically has been? You kind of like adjust your forecast for like what you think your business is worth that year. And then what you can do from there is say, okay, if I have an idea of what my daily expectancy is, I have an idea of how much this business should be making. And then I can step backwards and say, how much volatility, like let's say I want to target a 2 sharps, how much volatility am I willing to accept? So I know that for a 2 sharp strategy, I should be willing to accept 8 times as much variation in my daily P&L as my average profit, right? So from there, you can say, okay, well, that then allows me to put guardrails around how much vega I can have, or how much delta risk I can float without needing to be hedging all the time, right? Remember, hedging is a cost. So you can say, well, I'm willing to tolerate, let's say I got a business that makes $5,000 a day with $40,000 of variation. It's okay for me to have $1 million of unhedged delta in a day, because $1 million of unhedged delta in a day, but on a 16 vol name, um, is that's 1% a day of variation. So that's only $10,000 of variation due to $1 million position, and I can tolerate $40,000 of variation in a day, and my business makes sense. So I don't really need to be hedging every time I accumulate $1 million of random deltas in one way or the other, right? So because I know how much risk tolerance I can have to sort of target that sharp. And you can kind of walk through that for every kind of Greek. You could say, your main ones being your vol and your delta risk, right? So you could say, if vol moves around, if in a typical day vol can move around by 2 points, then having 50,000 vega is way too much, right? Because now in a typical day, I'm having $100,000 swings due to vol P&L in my vega, but my business really should only be swinging like $40,000 a day. So that's too much vega. So maybe my vega limit should be more like 10,000. Then my vol P&L is swinging around like $20,000 a day if vol moves 2 points a day. And now I've zeroed in on like a reasonable risk limit. I mean, the complexity could go pretty far from there, because you're talking about like, what's my gross risk limit? What's my risk limits within months? How do time spreads move? Like you could, this is like, as you get more into like professional caliber stuff, like there's no end to like how complex you can make this. But the main principles are this simple. It's just the details are where the complexity is. So anyway, this is by having an idea of if I have deltas paired off with each other, and that's very common. For example, in the course of market making, you're accumulating, a trader is accumulating deltas in all kinds of directions. I sold calls over here, I bought puts over there. Um, you know, I'm where all day long I'm getting pinged and hit on stuff, and uh, I'm accumulating all these deltas, and I might not care about them because I've got some system that says like, well, you're long 75,000 shares of XYZ, and you're short 30,000 shares of ABC, and ABC is has twice the beta of XYZ. So I feel like I'm pretty beta neutral right here, and all of these positions are just rolling up into like a master repo, and then that from there you might say, oh look, we're now like we're long, $100 million deltas in S&P terms. In S&P terms, meaning we do the calculations we did earlier, and we converted all of our deltas into like SPX equivalent deltas, and we say, okay, I'm long 100 million S&P term, $100 million worth of S&P. I need to go sell 500 or 5,000 e-minis and whatever the multiplier is. And then I'm locally hedged. I mean, yes, I'm accepting a ton of risk remaining on these individual, like how every one of these individual names kind of works. Like I'm accepting all this correlation risk, but like I'm mostly hedged. And then what I can do is then say, okay, now I'm going to be 1% of the volume in all of these stocks as I work out of all of these deltas over time. That way, I'm trying to minimize my market impact in these stocks. So rather than feeling like I need to go hedge all the deltas in each one of these stocks, I'm like hedge at the portfolio level. By versus futures, and then over time I work out of the individual names to get to reduce all my basis risk, and then as I cut my gross, I can cut my S&P. As my gross gets cut, I can cut my S&P futures position commensurately, so we're staying roughly beta neutral over time. That's um, that's the gist of like how market makers are sort of thinking about risk and managing deltas across a book, balancing the idea that hedging is a cost. Um, hedging is a cost. It reduces risk. It doesn't reduce risk completely because there's always risk remaining. There's always IDIO. All of that is heavily monitored. If you're short S&P futures and you're long the top 50 names in the S&P against it in a dollar neutral kind of basis, you are then synthetically short, you know, all the littler names, right? So if you have some like really big move in the 400th name in the S&P, like you're going to get hurt to that because if it has a big move to the upside, you're going to get hurt to that because you're short the futures, which have some proportion of that 400th name in there, and you don't own any of that 400th name in your basket. So that's called synthetic risk. So, uh, trading firms will can monitor, like they know what all their synthetic risk sort of looks like underneath the hood of all this beta neutrality. They know what all the IDIO risks are underneath that, and then they can kind of constrain that as well. So, and that will determine like whether they should go hedge the actual name itself, or um, uh, it's like, hey, this is way too much synthetic risk in the 400th name in the S&P. I don't want to have that. So we're going to actually go and cover some of that specific position rather than just papering over it with S&P futures and just trusting the beta on that. But anyway, this tool, super easy to use, requires nothing more than Microsoft Office. We're gonna build it in Moontower because we already have the data in there, and then a user can just pull up a pair, do the same kind of analysis. It's all in a web-based sort of UI, which is pretty cool. We can probably even add like more stuff to it. I have other ideas to add to it, but yeah, and for people that are paid subs to the Substack, I will share the spreadsheet for paid subs. I like to have something to be able to give to the people that pay. So that's anyway. I hope this was helpful, and I will. Like I said, I'll put this up on YouTube, and I'll also put the links to the articles that actually work through the math, the derivations themselves. Um, but yeah, that's all. I hope this was helpful.